Group Statements, Chapter 5, Example 5.2. Example 5.2 looks at the scenario where there's the intra-group sale of inventories by the subsidiary to the parent. All the information in this example are exactly the same as in example 5.1 except for this fact. The subsidiary sold to the parent, making the subsidiary the selling entity and the parent the buying entity. All the at acquisition information is the same, as well as the provided trial balances. The additional information is also the same except for the last two bullets. Now the intra-group inventory sales is by S Limited to P Limited at the agreed profit margin of 10% on cost, and the total sales and purchases for the current 20x11 reporting period amounted to 70,000 Rand. So the difference compared to example 5.1 is that S Limited is now the selling entity. From this example, you would now pick up that it becomes very important to identify who the selling entity within this intragroup transaction is. P Limited, as the buying entity, had the following inventories on hand that were purchased from S Limited. From this given information, we then gather that there will be unrealized profits that we have to deal with. Because we had inventories on hand at the end of 31 December 20x10, out of that amount there will be an unrealized profit in opening inventories in 20x11. And from the inventories on hand at the end of 31 December 20x11, there will be an unrealized profit in closing inventories. The at acquisition consolidation journal entry in example 5.2 is exactly the same as what it was in example 5.1. The intra-group consolidation journal entries applicable to this chapter specifically relates to the intra-group sale of inventories. The first intra-group elimination journal entry that is necessary is for the elimination of the total sales and total purchases intra-group. Journal 2, you would see, is the same journal as what we had in example 5.1. We have to debit revenue to eliminate that intra-group revenue, and we have to credit cost of sales to eliminate the intra-group purchases. The only difference from example 5.2 compared to 5.1 is that the revenue of S is now eliminated, as S was the selling entity. Therefore, the cost of sales of P, including the purchases of P, is eliminated, as P is my buying entity. In example 5.2, there is an unrealized profit in opening inventories and an unrealized profit in closing inventories. The unrealized profit in opening inventories has to realize in the current reporting period, as those inventories would have been sold during the current year. Journal 3 and 4 can be combined to achieve that process. The inventories that was on hand at the end of 20x10 would have been sold by the end of 20x11 when we consolidate. Therefore, there's no journal entry necessary to change these inventories as it has been sold. The journal entry for the unrealized profit in opening inventories is a debit to retained earnings opening balance and a credit to cost of sales, as it moves this profit out of the retained earnings opening balance of the selling entity into the profit of the group. The difference when compared to example 5.1 is that we now debit the retained earnings opening balance of the subsidiary and the cost of sales of the subsidiary. The amount of 400 was calculated in the same way as in example 5.1. Journal 5 eliminates the unrealized profit in closing inventories through the journal debit cost of sales credit inventories. The amount of 600 is again the same as it was calculated in example 5.1. The only difference when compared to example 5.1 is that we now debit the cost of sales of the subsidiary to eliminate this gross profit in the group. The selling entity being the parent's inventories is adjusted to prevent overstatement. The objective of the since acquisition consolidation journal entries is to measure my NCI in the consolidated financial statements. Journal 6 attributes a portion of the opening retained earnings of S to the opening balance of NCI. I start with my trial balance opening retained earnings and I adjust that trial balance amount for the effect of related consolidation journal entries. There was an at acquisition consolidation journal entry where I eliminated the at acquisition retained earnings so that I'm left with the 35,000 since acquisition date movement. In example 5.2, the subsidiary was the selling entity, so we had a consolidation journal entry to eliminate the unrealized profit in opening inventories from the retained earnings of the subsidiary and specifically the opening retained earnings. This is different when compared to example 5.1 because we now have the subsidiary being the selling entity. After I've adjusted the trial balance retained earnings amount, can I now attribute to NCI at 30%. Journal 7 attributes a portion of the current year profit of the subsidiary to my current year NCI movement. My starting point is the trial balance profit of the subsidiary. From chapter 4, we remember that we adjust the profit of the subsidiary for the effect of those consolidation journal entries that first of all do change group profit and secondly changes the profit of the subsidiary to achieve that change to group profit. In example 5.2, the subsidiary is the selling entity, so the adjustments against cost of sales for the effect of the unrealized profit in opening and closing inventories relates to the cost of sales of S. So I have to take that into account before I attribute to NCI. The 400 Rand was that unrealized profit in the opening retained earnings that I've moved to the profit for the current year. And the 600 Rand relates to the unrealized profit in closing inventories that I have to exclude from the current year profit of the group because it has not yet realized. Please note, I am changing the profit of the subsidiary for the effect of the unrealized profit in opening and closing inventories because the subsidiary was the selling entity and both Journal 4 and 5 also changes the profit of the group. As you would see here, I am not changing the 65,000 Rand for the effect of Journal 2, where the total intra-group revenue was eliminated. That is because Journal 2 does not change the profit of the group, and consequently it should not result in a change to NCI either. After I've adjusted the profit of the subsidiary for the effect of Journal 4 and 5, do I attribute a portion to NCI? Please compare this journal to the same journal in example 5.1 where we have not adjusted for the 400 and 600 Rand because in example 5.1 the parent company was the selling entity.